Hey, good morning, everyone. Marty Mazzora here, 26th of June, 2019. Thought I'd update you for just a few minutes. This one I can keep quick on the video here this morning. I can keep it quick because not a lot's changed since the last time, other than this flag pattern that I pointed to here. The last video that is a very bullish looking pattern. This is a bullish flag. That when it resolves to the upside, you tend to get a move about the same distance as the flagpole itself. However, it did break down, as you can see here, yesterday and the day before. And breaking down of bullish patterns tend not to be good things. If it's a good, strong pattern, it looks like traders are counting on it, then it can get kind of ugly to the downside. Yesterday was the ugliest day. You see that big red candle here. That was the ugliest one we've had for a while, probably back here in May. This day here, or this one, would be comparable. And as I said in here, you get a situation where if we break out, the bears get trapped, the shorts have to cover, that pushes things up, sucks in the bulls. Sentiment was not all that bullish, therefore there was some money that could come rushing in. I think it did, and then I said you get a bull trap if you get a breakdown in the news or what have you. Market gets sold, these folks sell, and so on. Last evening looked like U.S. futures were pointing to somewhat of a further drop, not dramatic here at the open today. Then we got news early this morning. It turned out to be a headline that really didn't depict properly what was said. It was Treasury Secretary Steve Mnuchin said we were 90% to a deal with China, and we hope that good things come out of the talks this weekend. What the headline said is that the U.S. and China is 90% to a deal. Clearly, what Mnuchin was referring to was the talks before they broke down here, a month or two ago, not where they are currently. The market sprang to life. Dow was up, I think, 180, maybe a couple hundred points in the futures market, and came back down to where last time I looked, the Dow and the futures was up maybe 60, 70 points. So that really didn't change anything at all. In fact, I saw a tweet later where the president said that, maybe he'll go 10% if he needs to ramp up the tariffs instead of the 25% that he talked about. That's not good news in any way, shape, or form. For whatever reason, and they virtually have to be political, the administration doesn't seem to want to give up on the existing tariffs that have been added or the potential for adding more, despite the fact that hundreds upon hundreds of companies have descended onto Washington this week, pleading with the administration, making some really compelling, real life, real numbers arguments about their own businesses and what the tariffs have done and will continue to do in worse fashion going forward to their companies and to the economy. Yet we don't seem to want to get off this bandwagon. If we don't, my view is that we will indeed be looking at a recession sometime 6 months to a year from now, and a really ugly bear market that comes with it. So this needs to get remedied. The data is coming out day after day, and for the most part, it's getting weaker and weaker this morning. The durable goods numbers were the worst in 3 years. So let's hope that cooler heads ultimately prevail, but let's hope that ultimately happens soon. In terms of 90% there, that extra 10% is enormous. For one, it virtually has to be China demanding that the new tariffs go away. This is something, frankly, that I was saying from the get-go, that I don't see China agreeing to a deal that doesn't eliminate all of the new tariffs that have been added since the trade war began. Actually makes a lot of sense, and I tell you, it'd be music to the ears of U.S. companies and should be music to the ears of U.S. consumers. The other part of that 10% was the U.S. demanding that China stop government subsidies, stop dumping goods onto the U.S. market, and so on. Essentially, and frankly, stop doing U.S. consumers enormous favors at the cost of Chinese taxpayers. Folks, just so you understand, when a country dumps steel or dumps lumber or dumps some good onto someone else's economy, what they're saying to those consumers is, hey, you get a huge limited time opportunity to pick up some stuff really, really cheap. Now, you have to conclude that that is really good for your economy because it frees up a lot of capital that can be distributed in very diffuse fashion across the rest of the consumer economy. And the US is a consumer economy. But invariably, what it does is it upsets generally a very concentrated, often politically powerful group of US producers, of course, the ones who produce the product that competes with the one that's been dumped onto the economy. And I absolutely understand why they're upset and where they're coming from. And I respect their desire and their action in terms of what they do to lobby against that dumping. It's in their own best interest. But to pretend that it's not in the best interest of the US consumer who has access to that cheap good, and frankly, the US consumer-driven economy is just frankly wrong, and it's really a bad narrative. If China wants to use its own taxpayer money to subsidize goods that you and I want to buy, making our lives better because we have access to something cheaper, the last thing in the world we should be doing as consumers is complaining about that. But it always happens. And the politicians and the affected industry do a wonderful job of convincing the consumers that somehow they're getting screwed by this dumping or this foreign subsidy. Not the case, but it will seem to be the case forever. This is one we're not going to change. But I think every opportunity I should be educating my viewers about how this stuff works. And one thing that we've been saying here from the get-go is that tariffs don't. China does some things that we don't like. Last thing in the world we should ever do is shoot ourselves in the economic temple to get them to stop doing what they're doing. If this continues, folks, and some of you have challenged me on this over the last couple of years, and I think you're beginning to see what I was talking about. If this continues, it'll get ugly, and we will have to take action within client portfolios. Right now, our assessment of conditions, although the data has weakened this week, has actually improved the last 3 weeks. Our macro index, that's something we do here internally, has actually improved, and the number went from a 10.5, which is getting too low, to a 26 last week, which is much better. I'll be surprised though if we don't get some contraction in that this week, but we're still a long ways from zero, which means we're still a ways from recession. But I think we accelerate in that direction very quickly if we don't get this trade war off the table. Okay, so I said it'd be quick. Sorry about that. Here's the chart again. That flag pattern looks like it's failing at this point. Makes a lot of sense to me. In terms of the other indicators that we like to look at here, on balance volume is rolling over. We have the market moving into new all-time highs, but we have more volume on the down days, which means there's been more passion on the side of the sellers. That's not bullish. That does not lend itself to this moving sustainably further into all-time high territory. The moving average convergence divergence, momentum indicator, still in a bearish divergence. Looks like it's beginning to roll over a bit. That's what that histogram suggests here. And then the relative strength index as well. Very much a bearish divergence, rolling over in the face of an upward trend here. This is all confirmation that at least at this juncture, this market is really not in the mood to go sustainably into all-time highs. I see this stuff reversing violently to the positive if we can get a trade deal over the next few weeks or months, and it's probably going to take that long. Highly unlikely that it happens this weekend. Doesn't mean that we don't get something in the form of a tweet that is very, very optimistic and it doesn't push this market higher. But until we get something else, and that is, frankly, a trade deal that I think has to eliminate all existing tariffs and eliminate the threat of just impulsively adding tariffs to our trading partners going forward, we're just going to have a really tough time. making higher highs in the foreseeable future. And this economy is just going to get worse along the way. I wish I had more of an optimistic story to tell you. I will get crazy optimistic if we can get this trade stuff off the table soon. Thank you as always, folks, for watching and listening. And of course, I'll be back soon. Take care.